we're going to continue with Hendrik Becker from the Deutsche Bundesbank, who will talk about central bank digital currencies and their impact on the monetary system. Hendrik Becker is an economist, and he's currently studying for a PhD as well, and he's specializing in this topic of CBDCs. And yeah, it's really great to have you join us, Hendrik. Yeah, let's get started.
Well, okay, so thank you very much, Makoto, for organizing this fruitful and inspiring event. And yeah, thank you, SORA, for having me. I'm looking forward to support this economic forum. I'm happy to get the opportunity to talk about today's topic, what is central bank digital currencies and the impact on the monetary system. So let me just shortly introduce myself. So I'm an economist working at the Bundesbank, the German central bank, and I have some work experience in the monetary policy department. And why do I talk about CBDC? Well, I follow the discussion from its beginning. So at least in Europe, and I always had contact to financial market infrastructures and topics around those things. So right now I'm conducting some fundamental research on CBDC, and I'm happy to share my thoughts with you. And before we start, just the short disclaimer that the thoughts I present are not necessarily the official position of the Bundesbank, and I'm happy to present my personal opinion on this topic here. So let us start with today's agenda. We start with public and private money. What is it, and how do we distinguish between these two often referred forms of money? Then we come to the motivation for CBDC. We need to take one step back, and we need to talk about the motivation in order to understand later on how the motivation differs from other motivations in the past on approaches to change the financial system. What is namely today a sovereign money system on one hand and the free banking proposal on the other hand. We will come back later on to this point. Then how do we need to think of CBDC in the financial system? We provide some fundamentals to understand later on what is new with introducing CBDC, and why do we observe a long-lasting and possibly hardly reversible shift in the monetary system. Then we cover the question, does CBDC change the system? We use a rather simple approach to answer this question. And we answer the question, does CBDC change the way the system works? What is kind of different question? We will examine what implications we expect for the future. I'm then going to introduce two other more extreme ideas which came up in the past to change the system. One is, I already mentioned a sovereign money system, and the other is the free banking proposal. And both ideas work exactly the same mechanism CBDC may work. Therefore, it is quite interesting to sort a central bank digital currency into these considerations just for comparison reasons. So we compare those proposals with the motivation on CBDC to see parallels and some differences, what is really interesting to see. And in the end, we come to the heart of today's talk. Will CBDC affect the economy positively or negatively? And what are the results of our exercise today? So in the end, I'm looking forward to refresh an exchange of views, some refreshing thoughts, and an interesting discussion. So I'm happy to answer your questions in the end of my presentation here. Okay, so we come to our first point, public and private money. So let's dive into it. On the right-hand side, we see many private banking institutions. And all these institutions issue private money. the money you have in your bank account probably is private money. And the reason is that your deposit account is basically a contract between you and your bank. And if you like to hold public money, you need to go to a bank and you need to withdraw cash. We divide private from public money in this presentation here with the gray line you can see here. So down below you have some symbols of major central banks in the world. And of course, public money exists not only with banknotes and coins, but also with central bank reserves. But these are not available for the general public. So reserves are typically existent between banks and the central bank. So their amount and price typically has monetary policy effects. So they do not matter right now for the investigations we do in our context today. So what is exactly the difference between public and private money? Well, it's quite easy. It depends on the issuer. And this is all the magic here. So now let me present the more or less famous money flower from the BIS to you. I think this is really a good way of showing the difference between different forms of money and how monetary system works with the coexistence of different monetary assets. So what can we see here? Let's start with the left-hand side. Do private households or do banks have access? That's the deep question here. If there are no restrictions on who is able to store and make use of this kind of money, then we have the universal access. Then the second point, electronic, I think this is quite self-explaining, but the next one is central bank issued. What means do we approach the public money, or how it is called in literature, rather often also outside money? And then we are in the blue circled area. And then we have the peer-to-peer dimension. When we exchange money bilaterally from person to person, as we know a transaction using cash, then we observe the peer-to-peer transaction here. The only form of money which fulfills all categories here is the retail CBDC. How does it differ from the wholesale one? It's the universal access. So retail is available for everyone, while wholesale is only available for wholesale agents, which are typically banks, payment systems, or money market funds. And in the Eurosystem, retail CBDC is defined a bit different. So they say it does not need to be available for everyone. Of course, households and merchants are included, but what is missing is a little bit the idea of large corporates and large institutions who make use of it. So they should not be excluded by definition in the end, but it's not unlikely, at least, that design proposals would make a central bank digital currency for such institutions extremely unattractive and thereby somehow excluding them by design. So the reason for this is mainly financial stability considerations or monetary policy concerns. And but this is not our topic today, but just for clarification where we are for this presentation now. So, well, now we are well equipped for the second main point. Where does the motivation for CBDC come from? Where does the strong research focus come from? And there are so many different reasons. There are so many potential justifications named, but they are often mixed and not very well structured. And we could talk 1 hour and only about motivation, but we don't have the time. So let's keep it rather short and simple here. We start with the efficiency. CBDC may lead to large efficiency gains. So central bankers and scholars model it a lot more efficient than existing forms of money. as it is by assumption easy to use, cost efficient, largely available. So there are many points that are covered with the CBDC. There are no deep frictions, and we have the opportunity to make use of a new technology, which will reduce marginal costs for money holdings in many models. Then we have increasing speed. Of course, many economies already introduced instant payments. However, at the moment, this is not really the status quo. So CBDC may lead to faster payments. And also the G20 and the BIS heavily pursue improvements in cross-border payments, as they are typically known as relatively slow, relatively expensive. Then we have the robustness point, which is raised in discussions very often. Offline functionality for payments and backup system for crisis situation. As a central bank infrastructure, we would see a high degree on cybersecurity and a high degree on robustness and intensive maintaining, as it would be an official financial market infrastructure. Risk-averse central banks would heavily invest in keeping a system like this reliable. Then we have the financial inclusion point, which is a very interesting argument, as it was in the beginning stated generally by many different politicians and many different central bankers. However, in many recent publications, this argument is fading more and more. At least in Germany, as a developed country, approximately 95 to 99% of all inhabitants have access to a bank account. And even in developing countries, the share increases step by step. In these countries, it is still important as an argument often, but it gets more differentiated, from country to country with this argument. Then we have a very interesting point as well. It's called the monetary anchor. This is a strong argument. It is often referred by the Euro system, and it's originally introduced by Markus Brunnermeier from Princeton University. And it basically means that there need to be a digital form of public money in the digital era where cash is not available and where cash is less demanded by the public. So in case a stable coin and different denominations of this stable coin will come into bloom in the digital economy, one would need a CBDC to find an anchor for all these new forms of money. And this is why it's called a monetary anchor. Then we have, of course, monetary policy considerations. Proponents often name a more direct transmission or the opportunity to increase output or stability by having a CBDC, making the economy overall more robust against shocks and unforeseen events. A different perspective refers to the threat of dollarization in the country, so kind of monetary sovereignty. And all these points are in this main argument. Then we have at the seventh argument, it's the supporting competition. We have also a large track of literature which discusses efficiency gains and welfare improvements by eliminating monopoly gains at banks. So they clearly state that CBDC as competitor to private deposits and as an outside option for households helps to overcome monopoly or oligopoly rents. And then last but not least, we have the programmable payments on a DLT. So having a CBDC could make it possible to have a stable and public form of money to purchase goods and services via blockchain contracts. We have large room for machine-to-machine payments, for smart contracts, for micro payments, pay-per-use exercises, and so on. So all those points together bring a large potential, as you can see. Okay, so after we have covered what CBDC is in comparison to private money, and after we discussed some main motivations, we now like to get an imagination on how the monetary system actually looks like, okay? So let us start with the monetary system by showing you public money only at this stage, as this is where CBDC adds the game. So we can define a 3-layer architecture. Down below, you can find you and me as a household or a firm. And as already mentioned in the beginning, we are only available to hold public money in the form of banknotes and coins. Where do we get our physical money from? Well, from a commercial bank. So layer 2 is the commercial banking system, and they are available to exchange banknotes into central bank reserves and reserves into banknotes by simply withdrawing or depositing cash at the central bank's account, as you are familiar with that mechanism at your commercial bank as well, just on a different layer. So commercial banks need to cover basically the demanded amount of cash with full elasticity. And the reason why they can do so is layer 3. We have the central bank with the monopoly supply of reserves and banknotes in the current stage. We see currently households can access only banknotes as this form of public money. But what if we introduce CBDC in this 3-layer architecture? This is what you can see here on the right. Then our first layer has the opportunity to access a second form of public money. In most policy papers, it gets clear that households and firms would still interact with commercial banks or other intermediaries to access this form of public money. Probably we can draw many parallels to banknotes in this mechanism, even though intermediaries can hold cash nowadays. They don't really use it for transaction purposes. And it's like, and it's very likely that it becomes the same for CBDC, at least for the retail purposes. Exactly the same 3-layer architecture, which I introduced you, can be shown in some balance sheet arithmetics. So we again have in blue the public money supply, which we are already familiar with now. And we now abstract from corporates. We will include them into the household sector here. That does not really matter. I don't want to get into details on this page, but we have 3 important amendments here. So we now distinguish between public and private money via colors. So blue is the public money and yellow is the private money. And we compare 2 worlds. So one without CBDC and one where we have introduced it into the system. And we define 2 variables. So banknotes and CBDC as public money are defined as chi here, and all monetary assets together in the system are defined as phi. Does CBDC change the monetary system? What would you say intuitively? Yes or no? Well, of course, it always depends on the definition. So yeah, let's keep it simple here. Let's closely look at the household's asset allocation. So currently, the monetary system consists of private money and what is bank deposits, and public money, what is banknotes and reserves. And introducing CBDC into the system adds a second option for households accessing public money. And it is not possible to reach this equilibrium endogenously here. So back to the question, does it change the monetary system? We can say, yes, it does. Households' asset allocation can change when we introduce CBDC, what would not be possible at all if central bankers would keep their feet still. So without actively introducing it, one could not endogenously reach a status where households can access this second form of public money in addition to banknotes. So we can answer this question, and we have our first main result for today, that CBDC changes the system, and this is quite reasonable. Okay, so we are now interested in the question whether we notice a change, or if this is a problem for the current monetary system. And in order to analyze this question, we focus on the share of public money, what we call G, by the way, to the total money supply. So the total monetary assets in the system, which are phi in this formula. And this share is strictly between 0 and 1. Let's define a qualitative scale as well in the trade-off between public and private money, what you can see in the dark gray part here. Only public money is called from now on a sovereign money system, while only private money we refer to the free banking system. And therefore, we can define an indicator which gives us information on where we are on that scale. And we call it a money share indicator. And we pour this indicator into the variable C. And in order to conduct a kind of comparative statics later on, we define that indicator over time. Okay, so back to the question, do we notice a change when the monetary system develops in the direction of a sovereign money system or in the direction of a free banking system? This depends on the money share indicator. So by dynamically observing the change in the share, what is the small c t plus 1, we can make a statement in which direction the monetary system moves. So it's a very simple indicator, actually. We calculate the share of public money in the system, and we compare this share from period to period. And when the relative share of public money increases, the indicator is positive, and we know that we move to the right-hand side. And if this indicator is negative, we move to the left-hand side on this scale. Okay, so I think this is quite understandable. Let's get to the interpretation. So we can do kind of comparative statics, and we can explain when we reach which value for the indicator. Let's assume monetary assets remain constant in the short term. If we let them grow, it's possible to conduct a case distinction as well, but we don't want to make it too complex right here. So we have three main cases. We start up there with case 1, where the indicator is 0. So we have no fundamental changes in the functioning of the financial markets and functioning of the system. The share from public to private money remains constant, what means that banknotes are substituted 1-to-1 with CBDC. And bank deposits as a form of private money in the system remain constant. So then we have a second case. This case we have already seen on the slide before. It is when the share from public to private money increases. So if more bank deposits, then cash gets substituted. So then the monetary system converges to a sovereign money system with public money only. And even if banknotes are substituted at the same amounts by CBDC, each unit that turns from a private deposit money into the CBDC as a second form of electronic money in the end changes the functioning of the financial system. What means that the public sector's role increases with, in the end, effects on markets, with effects on risks, and in the end, allocation of financial resources. And we have the third case, which is also possible when we introduce CBDC, is when it substitutes a part of a heavily decreasing share of banknotes. So let's imagine banknotes are no longer demanded and CBDC is there to rescue the public money. When this share is not as high as banknotes today, then we even go in the direction of the free banking system. So in this case, we can imagine that banknotes are no longer demanded, let's say, and CBDC may not be attractive enough to come to the same amount that banknotes brought. And then we have a drop in demand, and we see the case that this indicator is negative. So what can we say about the effects CBDC would have on the monetary system? We already figured out the introduction changes the monetary system with allowing to access an additional form of public money. And we see that this makes it possible to reach a monetary system with only private and only public money in the two extreme cases. Of course, only private money can be reached also by less demand for banknotes, but only public money is merely possible right now by withdrawing all bank account balances you have into cash. So, however, then electronic transfers are no longer available to individual households and firms in the current system. And this is what keeps our system in the distance to a sovereign money system right now. What we can say is that the effects of a CBDC introduction are ambiguous and lie between those two extrema. However, thoughts about changes in the system are not new, and there are voices since early times who claim a fully private or fully public monetary system. And we know all these proposals have been voiced before a CBDC has been discussed technologically. We see that changing the monetary system works almost every time in a similar way. Most proposals stem from a certain motivation, and they always like to achieve a predefined goal by triggering changes in the share between private and public money. And this is very, very important here. In the case of CBDC, we see again the development most likely into the direction of a system with relatively more public money, while some proponents are not really aware of what they actually claim in the context of some historic proposals on the financial system. So in a nutshell, the resulting effects of a CBDC on the system could be equal to the effects of other proposals, which have been voiced even earlier, although the motivation is totally different for the past proposals compared to the motivation for CBDC. And this is why I have shown you the main motivation for CBDC, as we now come to an overview of those two extreme scenarios. So in case you're not very familiar with past proposals and ideas, I will give you a short overview on both extreme sides of our qualitative money scale. So we have the sovereign money idea with many different authors. Irving Fisher as early ambassador. We have the Swiss Vollgeld initiative. You can read it up by Thomas Mayer. We have James Tobin with his Chicago plan for money. They all like to make public money available to the general public at a very large scale. And we don't want to draw the whole discussion here, but I'd like to present you a short overview on main arguments and the reason why some economists believe in such a system. So let's look on economic reasons, creating a safer banking system. Banks issue money, and they have, of course, a lot of risks on their asset side, as this is their job right now. And deposit insurance increases the probability of a bailout, those proponents say. And a sovereign money system would help that banks can go bankrupt without causing large economic problems. Then we have increasing economic stability. There is no pro-cyclical money creation in such a system, and high private debt, which normally leads to a crisis situation, won't exist. Then we have reducing the dependence on debt. So the expansive monetary policy increases debt in the economy normally, which leads to higher risks. And in the sovereign money system, the central bank provides money to the government, and the government conducts government spending. And this is not debt-driven in the end. They state. Then they say that monetary policy becomes more effective. Transmission via interest rates gets more effective, they say. Because they think that transmission is only very slow at the moment via the borrowing and lending behavior of banks. And when you are able to steer interest rates directly, this could become a lot easier. And they say that the government finances get better and more sustainable. Of course, we have also social reasons. So improving democracy and sustainability. Money creation is a sort of power which is not democratically legitimated. And even governments are dependent on banks right now and on their functioning. So the regulation, they claim, is really hard. And also they claim that they are able to slow the rise in inequality, as only few people profit from high debts, and the other part of the economy has a large burden, one could say. Okay, so this is to the sovereign money idea, and then we have the free banking era. On the other hand, important authors, of course, Hayek with his denationalization of money, Lawrence White with his book Free Banking in Britain. And we see only recently that there is a great society which supports cryptos as a decentralized form of money, which is privately issued. And there are very strong proponents on this idea that came up only recently, again, let's say. So the basic idea here is that money supply should be conducted through somehow competitive note issuance. So there is no room basically for a central bank. And the economic reason is that competition in the issuance of money should increase stability. Well, we see history may be proved wrong on this point, but they are still convinced that this is the best idea. We also see that market discipline, well, they claim that market discipline would limit money supply to what is actually needed. And as social reason, they say that, it helps that there does not need to be trust in one institution, and the system will supervise itself. Okay, so just to show you those two basic concepts here. And what we now realize is the effects on the monetary system are independent from the underlying motivation. What means that the same effect can be reached by totally different motivations, and many starting points may end up in an equal stage. So there are forces today with different names and different motivations, but in terms of changing the monetary system, they have similar opinions or fundamental values they like to convey. So I like to show you this slide once again. Even trying to keep the financial system as it is, CBDC will trigger adjustments, and it will have an exogenous impact on the household's asset allocation. It may not be harmful, but transparent communication on this fundamental, perhaps once in a lifetime adjustment would help to understand the concept a lot better. So discussing the function as monetary anchor, let's say, or monetary policy considerations, they only implicitly at the moment take into account the nature of a CBDC and its long-lasting effects on the monetary system. One point I'd like to add here is public policy makers often cause, of course, they fear a scenario with only private money more than a scenario with only public money. So we see that point when policymakers strongly favor CBDC instead of any private stablecoin or a synthetic CBDC, what has been voiced. So, however, literature by academics and policymakers, which likes to avoid banking disintermediation, what is rather often voiced, those literature disseminations only implicitly take into account a wish to stay far enough from a fully fledged sovereign money system. So they are aware that CBDC may change the system, but they only like to change it a little, and they don't want to get too close to a sovereign money system. And this is why they say that they like to avoid banking disintermediation. They like to stay in the system and change it only a little. Let's wrap up the main ideas by asking ourselves, what exactly is the effect on the monetary system? We know CBDC is going to add an option to households. They are available to add second form of public money. And the effects of this observation are ambiguous. So unfortunately, literature until now is rather vague on the overall effects a CBDC has. There are still strong uncertainties regarding the potential demand on the one hand side and the actual design on the other hand. So we have uncertainties on the supply and on the demand side, which add together to very strong uncertainties. And as most CBDC proposals, are more similar to bank deposits than to bank notes, the substitution effects may lead to a system with more public money and with all its consequences. So earlier proposals on changes to the monetary system were often extreme. However, introducing a CBDC allows to sort this proposal into the set of the past initiatives. So we lie in the middle, or we move on that scale in the future. So there will be change, but this actually does not need to be a threat. So let us understand change as an opportunity to get closer to all the goals that are either economically, politically, or socially desirable. Thank you very much for your attention and the opportunity to give you some insights into the effects CBDC may have on the financial system. And if you have any questions, comments, or suggestions, please let me know, and I'm happy to get into a Q&A with you. Thank you.
Yeah, so thank you, Hendrik. This was quite an exciting talk. To me, it's a really interesting topic because digital technology has made it so that we can start to rethink some parts of the financial system. And that's really what is going on with these proposals. And I like how you also tied it back into Fisher's 100% money Chicago plan, because many of the concepts and from a philosophical standpoint are the same as well. Because back then, Fisher also was dealing with changes in the technology and the introduction of new technology into the world. And we're doing the same thing now and having the same type of discourse in our generation as well. Generally, I do think that the logical outcome, if you kind of look at how things go, is that there will be more publicly created money versus private money created by commercial banks, partly because regulation of commercial banks is quite hard and cumbersome, and also because it's a constant drain on the economy, to be honest. So it seems almost like commercial banks should have to find some other way to make money. But I'm a little bit conflicted myself as to the best course of action, because if you already have an entrenched banking system, completely changing it overnight, of course, would be catastrophic. And it seems hard to find a way to kind of move things in a slow way. So later today, we'll have some speakers from a project called Valhalla DAO, who they're actually trying to set up many local not-for-profit community-driven banks, kind of run by like a DAO structure. And that idea is quite interesting because it decentralizes the decision-making a lot more. But it does mean that we'll have a continuation of this private debt-based money. So I was wondering, what do you think would be the optimal outcome for society?
Well, that's a pretty hard question, of course. As I stated, it's not clear that we actually move to a system with more public money. Of course, monetary policy in the last few years, at least in Europe, helped to blow bank balance sheets a lot. So there has been a lot of central bank reserves in the system, which are not available for the general public, of course. But if you change this amount into CBDC, then you probably make this kind of money long lasting for privates, as you won't be able to bring this fundamental shift back that easy. So on a more practical level, one could name this the size of a central bank footprint or public money footprint. And it could be measured by the degree of intermediation of public authorities, maybe. So an obvious form of intermediation relates to the extent that central bank operations replace market transactions in certain segments, at least. And a second type of intermediation is maybe the level of transformation performed via public authorities. So by holding assets and issuing liabilities, what the central bank performs, they conduct liquidity, maturity, or credit risk transformation, so via its balance sheet. And this is normally done by the private sector. And in case there are very strong shocks or so, this shifts to the public sector. And for instance, increasing the availability of some liquid assets for banks. This takes out some market risks, at least in the private sector, and this is what we see on the monetary policy side sometimes. And we don't know what effect CBDC has in this large ecosystem and all these networks that are important in this financial system. So it's there's a lot of research needed to understand what effects there actually will be, and it will be exciting to see how the financial system will develop in the next few years.
Yeah, I do think that we're at a kind of an apex of a lot of changes in the global financial system, driven by war, supply shortages, and many other factors. If you study monetary history in Japan, it's quite interesting because private money issuance seems to be the exception rather than the norm. If you go back to the I think around 500 AD or so to Japan, they had a Waido Kaichin, which was a public money created by the government, and you didn't really see large-scale issuance of private debt-based instruments until end of the 1800s. So there were, of course, problems with the old system. If you have a government as the only issuer, you do have very critical governance questions that you have to answer if you want to be successful, because history has also shown many examples of governments kind of minting themselves into oblivion. But on the other hand, this can be done by private banks as well, which has also happened historically. So it's quite interesting. I think the technology has a lot of potential to at least drive the discussion of these ideas, which is quite important. Though I do think technology is just technology, and it's not a panacea for changing everything. So there are a couple of questions in the chat. One is, do you think there will be a time in the future when retail CBDC, I guess, replaces banknotes altogether? And who do you think will be the most reluctant to change like that?
Well, that's also a view into a glass ball. So it's not very, I cannot, of course, predict the future. But what is interesting to see is that, of course, banknotes for transaction purposes, at least in the Eurozone, decreased time by time. So there is a long-lasting shift, we can say, in the preferences of people who use the money. And until now, we have no experience with a retail CBDC. And as I already have shown to you, the design is also not published right now. And there are very strong thoughts on various dimensions on how to design successful but not too successful CBDC. And therefore, we say that it will help to add as a second form, as I already mentioned, to the household's assets allocation, but it will not replace them at all, at least in the beginning. So we will see a second form, and then we will have a gradual shift until we reach a new equilibrium, let's say. And the most proposals I have read so far, they are more on the side replacing electronic forms of money. So a CBDC until now is only very seldom raised as a basic substitution for banknotes. So offline payments, of course, are discussed a lot, but most proposals deal with how do you make electronic transfers, as they are more important for internet transactions or for transactions at the point of sale. As we see, they develop into the direction of electronic payments. So I would say that banknotes for transactions may be substituted in any time of future, but there is still a strong community which values cash a lot. And on the question who is reluctant or who likes to use cash, well, of course, at least some research says that there is a strong demand by many Germans. We don't know where this comes from, but there is a strong favor for cash. I think it's partly the same in Japan, maybe, that there are also many people who favor cash, also with the privacy issues and some data governance that they have when they have the cash in their hands. And I think this is a very interesting point to see, and we will see where this develops.
I do think in today's kind of almost over-regulated world, having something like a bare asset like cash is it's quite a unique experience almost. So maybe that's part of the reason. But you're correct that in Japan people do prefer cash, partly because it's accepted everywhere, so it's like the default. And cards are not accepted everywhere, so you have to ask, do you take a card or something? It's not always obvious, and so people are reluctant to go with the non-default option. And also Japanese kind of like the game of making change and giving it in an optimal way. In fact, there's iOS games where you're given some amount in a wallet distribution of different coins, and you have to choose the optimal distribution. So it is something that people play with, and I have that experience myself too. So yeah, it's going to be quite an interesting time. I really look forward to your further research, and I'm glad that you were able to put together a very simple mathematical model that keeps track of what is the share of private debt-based currency and central bank issued money, because that's quite interesting to see how that could work. It would be nice to be able to do some kind of simulations in different scenarios and kind of predict what will happen. I do think that competition is going to be a big role. I mean, competition between nation states. So if one country opens up a CBDC with APIs to the whole world, it suddenly is global, and it can compete as a reserve currency if they want it to. And if we see that happening, then I do think that it will drive future CBDC designs. So obviously, the thing to watch out for is China, because they were very early in issuance, but they haven't yet decided to do anything internationally. It's more of a domestic system for now, but it's going to be quite interesting to watch. Also, cryptocurrencies. I think that's all the questions that we'll take for now, but I really appreciate you coming on today and giving such a thorough presentation. And good luck with your research, and have a good weekend.
Thank you very much, Makoto.